Thank you very much for joining me on this video. I want to talk to you today about an avenue of both acquisition and financing of investment property that I think is sometimes overlooked. And that's where the seller is himself or herself an investor. See, if I am buying a property from somebody who's living in the property, the chances are they need their money out to be able to buy wherever they're going. They're moving up, moving down, moving sideways. They need their money. But if it's an investor who's selling, he may be a long-term investor and he's just tired of being a landlord. So he wants out. So he's selling his duplexes, triplexes, investment property. And yet when you give him the money, he's got to do something with that money. He's not going to go buy another investment property because he's just decided he wants out of that game. What's he going to do with his money? Well, he can put it in the bank, but a really good suggestion would be, why not hold a mortgage, a vendor take-back? It gives the seller the advantage of having it secured against a property that he knows, having the revenue continue to come in, but not having tenants. I often suggest that the rate be set just a little lower than what the bank would charge. That way the seller is getting better money in terms of a percentage return than he would get if he just put his money in the bank, and the buyer is getting a better and more preferred rate on his mortgage than if he went out and shopped the mortgage with the bank. So it's really very much a win-win. And I find that landlords usually fall into one of two groups. They either get it, understand it, and they're wanting to acquire more, or they're not handling it well, or they've handled it too long, and they want out. And it's the second group that provides this great opportunity. It used to be that you could have buy an investment property from an investor, and you could arrange a first mortgage. Back then conventional was 75, now conventional is 80%, and you could get a vendor take back for the balance, bringing it up to say 90%. And the banks had no problem with that. But then in 2008, with the meltdown in the US, the banks tightened up their policy, and now they don't allow that anymore. I quite frankly don't understand it, because they're secure against the property, and any subsequent encumbrance or a second mortgage, the seller, that comes after them. So they're protected. But anyway, they won't. Now, there is a possibility with credit unions, because they don't come under the Bank Act, and I suggest that you maybe work on developing a relationship with some of these lenders that can allow secondary financing, and explore that possibility. There's another thing that I want you to consider, and that is where a senior owns the property. There's an awful lot of people, older people, baby boomers, retired people, that are house rich and cash poor. They're having a hard time making it work from one month to the next, and yet they've got lots of equity in their house. A possible viable solution for them is to sell the property to an investor and stay in as a tenant. Now they've got a chunk of money in the bank, and they're not responsible for capital expenditures. If the furnace needs replacing, or if the roof needs replacing, they make a phone call. It's not their responsibility any longer. Years ago, I had a couple in their 80s come and apply to rent a property that I was renting out, that I owned, and I rented it to them with a little bit of fear and trepidation, because at that time, he was 84, and they were responsible, of course, for the grass cutting and the snow removal, and I wasn't sure they'd be able to handle it. Well, they ended up being tenants for 11 years. They were wonderful tenants. And he had been a retired carpenter. He built a shed, put up a fence, all kinds of things. And the problem that they had was they lived in a house for years and years and years, and it was at the point now it needed some maintenance. Needed a new driveway, needed a roof. They didn't have the capital for that. So they sold it and decided that they would live out the remaining years with the revenue from the sale of the house. I wish I'd run into them before they sold. I would have bought their house and rented it back to them. But anyway, it worked out very, very well. And so this is something else you might want to consider. And another advantage to the senior is, while they're living in their house and they've got the money to now pay the rent, they may have their name in some kind of an assisted living, and when it comes up, they don't have to worry about putting their house on the market and seeing how long it's going to take to sell and waiting for it to close. They just give notice to the landlord. And from the landlord's point of view, he's got a really good tenant who knows the property, loves the property, is going to look after the property. It's also a possibility that the senior that you're buying their property from may consider holding a mortgage. They don't necessarily need the money, but the cash flow is important to them to subsidize their existing cash flow. And it may be when they do move into some kind of assisted living, they may be financially in a much better position, not having a chunk of money in the bank that could be signed over, but rather having a monthly income from the mortgage they're holding. And of course, their heirs will be appreciative of that as well. So it's a possibility that you can get them to hold get them to hold a mortgage exactly the same way as the investor. It's something you want to explore. For the investor, both are really good opportunities. For the seller, it's good. For the buyer, it's good. It's very much a win-win. Thank you very much for joining me in this video. Talk to you again next week.